All right, now beginning with this chapter, we really switch gears quite a bit from the previous material because now we're going to be dealing with, instead of service businesses, businesses that sell tangible goods. So this first section that you're going to be looking at here just deals with the accounts that get added to your business, to your chart of accounts, because you're switching from service to tangible goods. So first up, of course, most obviously, is you're going to have to add inventory to the list. And after every one of these accounts in this first stretch here, you'll see in brackets I either listed as real or temporary, TEMP period. That's what you see down here for this account, sales. Simply meaning, how does it fit into the real versus temporary paradigm? In this case, again, real means, just to recap that, means it goes where? It goes on the balance sheet. Temporary means it's on the income statement. You'll notice that the lion's share of the accounts we'll be looking at are going to be temporary accounts. Inventory tends to be your one primary real account that is going to be added to the system. All right, so again, we're switching to inventory. So all you're looking at here in this section I put together, whoops, still working on that coordination there. Yeah, so just kind of giving you just a quick, synopsis of like what do you have to worry about when you switch to merchandise, and there's your main concerns: acquiring, organizing, safeguarding, and of course ultimately selling it. Now, what don't we talk about in this chapter or in this class is how to deal with manufacturing goods, right? We're not going to talk about that, but I'll give you just the basic concept there, which in other words, that would be taking raw materials, labor, and overhead and allocating it. Now, again, that's the concern of the next class, Accounting 102. So when you take that class, it'll show you the different methods for tackling that. All right, so again, here are the other accounts. Again, most of these are going to be temporary accounts. So first one is kind of just a facelift, so to speak, and that is instead of going from like fees earned as your primary revenue account, now you'll say your primary revenue account is sales. So if you're talking about the way it would look in your chart of accounts, so this is now going to be your 401 account there. So 401 would be sales now instead. But what's the first, excuse me, what's the first big thing that changes because you're going from service to tangible goods? And that's, of course, and this is for most businesses, they will take returns of tangible goods. You can't return a service. You can be dissatisfied with it, but you can't return it. So we could, in theory, just directly, if we get something back, we could just debit sales, right? Just reverse the original entry. Debit sales, credit accounts receivable, for example. Why is that a poor practice? Because we want to track this. We want to track our returns and mitigate them. In other words, minimize them as much as possible. So to facilitate that tracking, what we're going to do here is we're going to add a new account called Sales, Returns, and Allowances. Get another temporary account, meaning it's on the income statement. This is a strange account. It doesn't really fit into any specific category we've discussed previously. So that's why it gets its own new category, because this is a contra revenue. That's what we're going to consider it. Now you'll notice normal balance of this is a debit, which means it's going to have the same impact on income as an expense. But again, does it fit the definition of an expense? And the answer is no. So where do we put it in our chart of accounts? Well, we're going to probably put it in the fours. That's usually how you see it classified. Now, you could just do this. You could say it's account 402, right? That's, but technically it's not another revenue account. It's a contra revenue. So really a better way to note this one, this is how I learned it once upon a time. I always thought this was probably the best way of tackling it, is say this is account 401.1. In other words, that 0.1 tells you that it relates to account 401 and also that it's a contra, meaning it will be subtracted ultimately from it somewhere, not necessarily on your books in your ledger specifically, but somewhere in the income statement, and that's what you'll see eventually. So that's a good way to indicate its nature. It relates to sales, but it's a contra. All right, so what's another concern you have in your hands? And that big concern here is how to get your customers that are, account receivable customers are going to pay you sometime later, how to get them to pay faster. Because again, you have this cycle of converting goods sold to cash and then back to goods acquired for resale. So that's why you always want to get those AR off the books as fast as possible. Reduce that line a little bit there. All right, so what do you have to do in order to get them to pay quicker? Well, you could just say, please pay me, in less than the net period, obviously, but probably it's not a very good incentive, is it? You maybe want to give them something in return for that. So that's where we get to the concept of sales discounts. Again, another temporary account we'll keep on our books here. This is also another contra revenue account. All right, now this has a normal balance. It's a debit. Sorry for the little disruption there. Allergies, what can I say? Anyways, again, this is going to look just like the one we just talked about. Because it has a debit balance, it's going to have the same impact as an expense, but again, it doesn't fit into the definition of an expense because we're not using goods and services. So we'll probably slap a 4 in the front of it. So to continue what I was discussing earlier here, you could also, again, do 403, or we'll continue the system that I presented above. Just make that 401.2. So once again, it tells you that it relates to account 401 and that it's a contra. It's going to be a reduction from somewhere. Now, specifically, what are we tracking here? Like the sales, returns, and allowances. Again, what an allowance is, you'll see later on. That's pretty straightforward. This one's a little bit more difficult. Again, we're tracking every time the customer, I'm not a fan of this terminology, by the way, but this is just the way it tends to be phrased, the cash discount. Again, they're not paying cash. It just means how much we're deducting from the cash that they ultimately pay for the accounts receivable. And we're tracking when customers pay within this discount period. And of course, you'll always notice, like if, for example, it could be 15 days, it's always going to be less than your net period, which is, of course, what you're describing at the forefront of the transaction, which usually is 30 days, as how long the customer has to pay the balance of the bill that's been issued to them. Now, the thing to understand, like to clarify this account, make it easier, is I have to throw in what you're not tracking here. Right? It's, again, very specific. You're only tracking when somebody pays you within a specified discount period, which is less than the net period. Things you're not tracking is what I just label generically as marketing discounts, meaning somebody 50% off sale, right? Everything in the store, everything we have online is 50% off. $100 item is now $50. We don't track that in the accounting world. That sale of a $100 item minus the 50% off equals $50. That's the amount of the sale to us. If the marketing department wants to track that, that's fine, but that's not going to be tracked in our record keeping. That's just the way it works. We're also not going to track what's called trade discounts. Now, trade discounts, as you see right there, trade discounts are like, okay, let's say you have somebody that's buying in bulk. How do you get them to continue doing that? Well, you knock something off the top. Like you might say all sales of $10,000 and more, knock 10% off. So somebody buys $10,000 worth of goods from you, and you say, okay, great, it's now $9,000. What do you book the sale for? $9,000. Again, we're not tracking trade discounts either. So marketing discounts, trade discounts, somebody else can track those, that's fine, but it's not part of the accounting function. That's the fact of the matter here. All right, next slide here. So we have a couple more accounts you're going to see incorporated in the system because you're dealing with tangible goods. Cost of goods sold. Now the temporary account. Now this is your primary expense account. Right, this is the big one. Because what are you tracking here? You're tracking just like it sounds. What did the company who's selling the goods pay for those goods? What is that amount? Well, then every time they sell goods, they're going to book that here. Now exactly how you determine what that is that's the next chapter. That's chapter 6. So for now, all you'll see in this handout, in this video, is just here's the amount that they determined to be the cost of the goods sold. And we'll just show you the mechanisms for how we book that. Now, because this is such an important account, what we're going to do is we're actually going to change the look of the income statement. It's going to go from the single step format, which is just revenue minus expense, to what we call a multi-step format. So you see that later on in another video. And this is so we can do what? So we can measure something called gross margin, which is also called gross profit. Now, I refer to both because depending on which book you're dealing with or which era of accounting you're dealing with, they tend to fall in and out of practice. You know, I learned it as gross profit, then it became gross margin, then went back to gross profit, and back to gross whatever. They mean the same thing, and you'll see what that means later on when we do the multi-step income statement. And lastly, for the ones that you're typically going to see, you might have delivery expense on your hands, get another temporary account. So this is when the merchandiser is going to pick up the cost of the goods that they're shipping out to a customer, and this is going to happen specifically when we have this situation. Those in the shipping terms are FOB destination, so they will book this immediately as an expense. That's the idea here. They incur that cost, they immediately book it as an expense, and they could also see this account go by the term transportation out. It doesn't have to strictly be just delivery expense. And you'll see again how all these accounts are used will be in other sections of the handout that accompanies this, and of course other videos. All right, so before we conclude this first installment here, we're going to look at periodic versus perpetual inventory. In other words, there's two ways you can tackle inventory, two basic systems here. So the first one, this is just for contrast really. Otherwise, if I just talk about perpetual, it doesn't really mean anything, so I just throw in like, hey, how did they used to tackle the handling of inventory? How did they used to account for it? So the periodic system was really the only system you could mostly employ. Not every business could necessarily had to rely on this, but the majority of businesses that dealt in like lots and lots of different goods, like if you had hundreds or maybe thousands of different things for sale, you'd have to rely on this system. There's no way you could use the perpetual system. We'll talk about it in a second. Just not possible. You need a computer in order to do that. You need some sort of mechanization of that process. So what were the characteristics of this system that's more or less outdated? And that is, first thing you will note is that you had a very inactive inventory account. Really not much accounting was happening in the inventory account itself. And where was the accounting happening then? Well, really a lot of it was happening in accounts that were used for purchases. So that's a big departure from what you're going to see here. And this is a huge difference from what you're going to see. Cost of goods sold was computed where? On the income statement. That's, in other words, you really didn't know what your cost of goods sold was as you were accounting for the business. It was a number that was out there that you were going to compute somewhere else once you had the data in hand. And of course, it's not impossible to figure it out like in the middle of the period. But again, it wasn't something that was at your fingertips. You had to go through some computational steps in order to figure it out. And then the big difference here, this is huge, estimating ending inventory. Your ending inventory balance was not the result of any actual hands-on knowledge. It was just like, well, this is what we believe it to be, because again, we're not counting everything as we're selling it. Therefore, again, your numbers are a little bit, because estimates are inherently inaccurate. Obviously, there's going to be a degree of inaccuracy here. It's a bit of guesswork, educated guesswork, but still guesswork. So again, this is just for contrast, but you will note that some of these concepts related to periodic system of accounting for inventory will be in Chapter 6, and you'll also note they are a lot more palatable in the context of Chapter 6. The system we are going to focus on is perpetual system. Again, because we have computers and barcoding, that's a big one there. Definitely for retailers, barcoding is a lifesaver. Right, so what are the characteristics here? So you'll see you have a very active inventory account. Really, everything's happening in your inventory account. So you have a balance in inventory. There are no specialized purchase accounts. Acquisitions are going to be what? Debited directly to inventory. And of course, as we see, cost of goods sold is an actual active account on the books and will be debited every time goods are sold. So it's going to be something you're accumulating during the period, not just backing into it some other time. And of course, we have an up-to-date inventory balance derived from beginning inventory plus purchases less cost of goods sold. So in other words, that's the key factor here, is we have an active inventory account, so we have a better idea what's actually going on there at all times. All right, so that concludes the sort of introductory material here. The next video will talk about what you're going to do if you're dealing with sales in a perpetual system. Bye for now.